basically the message is don't panic that inflation's at 3%. There are factors underlying that should see it go back to the Reserve Bank's 2%, and we're still expecting a rate cut from the Reserve Bank in November.
Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora, welcome back to the podcast. Today we've got quite a few things to talk about. We've got CPI inflation data for the September quarter that just came out hot off the press, basically, at the time of filming. So we're looking at, a bit of a reacceleration in prices. Not too much of a concern. Don't start freaking out just yet. We're going to explain it all. We're going to be looking at that. But also, MJ, you've recently done a bit of a deep dive into the spending data for Kiwibank, electronic cards and spending. Some definitely really cool insights. And it's been quite a while since we actually took a look at Kiwibank spending data. So it'd be good to look at what's happening there. And also there's been an announcement on a bit of a easing up on LVR restrictions. So we're going to discuss all of that today. It sounds like a lot of different things, but they all kind of marry up quite nicely. But where do we start? I guess, MJ, you were in the Stats NZ lockup today for the inflation data. Why don't we start there? What's kind of happening with the inflation rate?
Yeah, so I was in a lockup for this one, and this time around, no fireworks. Inflation's accelerated to 3% on an annual basis, which is what we expected. Over the quarter, consumer prices rose by 1%. Most of that increase, 30% of that increase actually came down to administered costs, so council rates specifically, led that increase. So right now, what we're looking at is a temporary lift in inflation driven by things like food and administered costs that are staying quite sticky. But if you look at underlying inflation, that's still very soft. It's clear that those more interest rate sensitive components of CPI, like rents and construction, those are clearly very soft.
Yeah, so 3%, that's the top end of the RBNZ's target band. But again, we're not really seeing this as a problem because of what's driving those costs. And you said part of that is the administrated cost, but also a bit of the reversal in tradable inflation, right, as well, that we're still kind of seeing continue play out. Yeah,
tradable inflation or importer inflation, that's climbed back up to 2.2%, which I think is the highest since the end of 2023. It's been correcting higher just with a weaker New Zealand dollar, but also food prices. I think meat prices are up like 12% on the year. So that's lifting imported inflation up. If you look at domestic inflation or non-tradables, that's more important for the Reserve Bank. That's a part of the inflation basket that they have the most control over. That continues to fall, but slowly because of these administered costs, which are domestically generated price pressures. If you strip out the kind of administered costs, domestic inflation is down to 2.6% as opposed to the headline being 3.5%. So we're seeing that it's staying elevated. Domestic inflation is staying elevated more for reasons of administered costs rather than, the interest rate sensitive ones.
Yeah, it's just quite out of the Reserve Bank's control. Because if we look at things like, let's talk about those council rates, they were up 8.8% over the year. That always comes through in the September quarter. And yeah, I just want to reiterate, that was 30% of the quarterly move higher. And then you have things, it doesn't really just end there. You've also got electricity prices, which particularly over the year are up 11.3%, which is the highest since the late 1980s, which when I was starting to kind of chart it up, I knew it was quite an elevated number, but I thought, maybe it'll go back to 2000s. No, it goes all the way back to the 1980s. So that's adding quite a bit of pressure. And I think what's really interesting, and let's just pivot to your spending tracker real quick, is that this is a theme that we've seen, kind of restraining consumer spending that, correct me if I'm wrong, but households are actually, because they're having to spend more on these essential items like council rates and your energy costs, they're actually not being able to spend as much in other, fun discretionary places.
Yeah. Yeah. You said that it's been a while since we did the spending tracker, and it has been, but the themes, unfortunately, are still very much the same. We're still very much facing a cautious consumer. They're spending more on those essential goods, which are the ones that are rising in price, like food. Food prices are up. Total value of transactions over the September quarter for Kiwibank data, that was up 5% over the quarter. Volumes lifted as well, but not to the same extent. So our trolleys are a lot more expensive. So we're getting less for what we pay for, basically. Also, council, payments on council rates, those utility bills, that was up 19% over the September quarter year on year. So it's very much reflective of these higher, more costly essential goods, and that's taking up most of the household budget. If you compare that to those discretionary items, which have been discounted quite significantly over the last couple of years, but there hasn't been that demand there yet. So prices have fallen for those retail goods, but demand for that has also fallen, so it's not quite enticed any demand just yet.
Yeah, we're back to just spending more and getting less, right? Which is a bit unfortunate. But, well, do we go back to inflation, or keep on the spending tracker from here?
Well, another essential good in the spending tracker, which I think we can classify as essential, is beauty and hair.
Oh, yes.
Because the value of spend there actually has stayed, or the volume of spend rather, has stayed quite constant, but the value of spend has increased. So that's a pretty inelastic demand there for beauty and hair.
Yeah, so what that kind of tells you is that even though the prices have tracked higher for, your beauty services, most likely, getting a haircut.
Yeah.
What was you saying, that we're pretty scarred from our COVID DIY haircuts, that we're still kind of forking out to pay that price. So what do they say? Beauty is paying. No, there's
beauty comes at a cost.
Beauty comes at a cost, and we're paying it.
Yeah, we're willing to pay.
But what about with, talking about food prices, which if we go back to inflation, was up 1.7% over the quarter, and that accounted for about a third of the quarterly lift higher in prices. What about, how is that feeding through onto the hospitality scene in terms of spend? Are we seeing that change in the Kiwibank data?
Yeah, it's interesting. It seems like our spending, we're kind of prioritizing cafes, and it could be a price consequence. It's relatively cheaper just getting a coffee and just, some cabinet food or something, rather than going out to a restaurant and spending up there. So demand for cafes seems relatively stable in terms of volumes. It's a good indicator of demand. But then there's no kind of denying the fact that the value of spend has been increasing because of things like food prices rising, and that's obviously having an effect on those restaurant meals and all the likes of that. So there is having an effect, but demand for those things, again, is relatively stable. Coffee is an essential good as well.
Yeah.
So from our spending data, it shows that, again, people are prioritizing, households are prioritizing those essential goods over the discretionary items. Another one of those essential goods are things like rents as well. That takes up most of the household budget. But we've seen a bit of relief on that side of CPI, right?
Yeah, so rental inflation, it's come off its peak, not too long ago. I think maybe about a year ago, rental inflation was a series high of 4.8%, and today that's eased, over time back down to 2.6%, which I think is the lowest since about 2019. We've reached that sub 3%, and that is really just a reflection of, the weaker net migration inflows that we're getting, and at the same time, we're also seeing that sort of weaker net migration inflows combined with the soft housing market feeding through onto construction costs. So for construction costs, building over the year was up just 0.8%, which is very soft. It keeps it at levels last seen since the GFC. So, it seems like it's a good time to build. But yeah, it's really just a reflection of the housing market that's still kind of lying dormant, and those, weaker net migration inflows that haven't come back yet. So, but I think we do have, promising development on the horizon for that. Like I said earlier, the Reserve Bank, they've loosened their, or planning to loosen their loan-to-value ratios from the 1st of December. Have you got the numbers written down?
No, I know you've got them though.
Let me just double check my numbers. So
it's a pretty big move.
It is a pretty big move, and it's going to help kind of getting things warmed up for the housing market. So for owner occupiers, the limit on new lendings for those with an LVR above 80% is increasing up to 25%. That's from previously 20%. And then for your investors, those with an LVR above 70%, that share of lending is increasing to 10% from 5%.
Yeah, that's a pretty big move. I mean, it's in response. I think we all kind of flagged this change. It's coming in December. Probably the impact of it won't come till next year. But we always flag this change because if you look at how housing credit has been performing, it's been well below the long-term averages. So there's no need to kind of have this chokehold on housing credit right now. And also we've got debt-to-income restrictions in place already, and so that's already acting as a guardrail for the next time we see a big lift in house prices. It kind of keeps those in check. So there's no need to have LVR restrictions at levels that they once were. So basically, banks are now able to lend a lot more in terms of those low deposits, which is going to be helpful for, I guess, those first home buyers, because it's usually them that are the most find it most challenging to
establish that deposit.
Exactly, to scrape up together that deposit. So it helps them get onto the property ladder as well, but also investors, they'll be happy to see that has eased back as well.
Yeah, I think, and we were pretty surprised that it went straight for investors from 5% to 10%, not somewhere in the middle like 8%. So yeah, definitely a decent move, and certainly something that the housing market we welcome in the housing market right now. But as you say, DTIs being in place kind of take a bit of that role anyways. So I guess keeping with the housing theme, we know that the housing market is still a bit depressed, but something in the spending tracker that was ticking up, and it's actually reversed from a couple of years, because I think we saw a period where spending on around the house goods went for a bit of a lull, but that's starting to pick up, right?
It is. It's been so volatile, really, that demand for household contents and furnishings. During COVID, you had everyone buying up pizza ovens and new TVs and new couches, but then that really fell away and kind of corrected lower when interest rates were high. And then now we're starting to see a bit of a pickup in that space, hardware, DIY kind of stuff. That's seeing a bit more life in that space. The volumes and the values have started to lift. And it could be that people are getting their houses ready for the housing market in the spring period. We know that's typically the busiest time for the housing market, and we are definitely watching it keenly to see any activity picking up. This shows us that maybe there's some signs of life in the housing market, that people are starting to think twice about doing up their house again to put it on market. So we're keeping an eye on that. That's probably one area that's starting to see a bit more life in retail.
We need that paint index we were talking about a couple episodes ago. Maybe we need to really narrow this down.
Yeah, because that tells you that tells you about the turnover in the housing market. People aren't going to buy a new TV or a new couch if they're not moving house. So when we start to see a bit more interest or a bit more demand in that space, it could tell you about how people are thinking about putting their houses up for sale or buying new houses. So
yeah, I guess it's hard right now because we did get some of the latest housing data for September, and that's still pretty soft. Doesn't really look like much has shifted, but maybe this is a prelude. But also maybe there is still a bit of just discounting that's incentivizing spend in that housing-related section, because I think if we looked at the inflation data that came out, at least for the quarter, your household contents and furnishings group, that one actually reported some deflation there.
Yeah.
So there is definitely some discounting there. Is it the discounting that's driving consumers to spend on those housing-related goods, or is it that they're sort of maybe prepping for an uptick in the housing market?
Yeah.
I guess probably a bit of both.
Probably a bit of both. And I think this upcoming Black Friday, Cyber Monday, kind of Boxing Day period will be a good kind of indicator of that. If we do see people coming back in and buying a bit more because of those deals coming around, because the Black Friday, it's growing in popularity in New Zealand, and it could be those deals enticing people in. One space in retail that does seem to be working in terms of deals is in movies and events, right? I think you were looking in the data and we were seeing how the volume there has actually outpaced the value of transactions in movies and events. So it shows that deals can bring demand.
Yeah, absolutely. Yeah, looking at the movie spend category in our spending tracker, it's always fun because there's this one big spike, which was Barbenheimer back in 2023.
Yeah.
Crazy that it was 2 years ago.
Yeah.
And there's just been no double blockbuster that's been able to trump or even come close to recreating that same effect. So looking at sort of more longer term spend, I mean, I guess the volume of spend at the cinemas is still lower than it was pre-COVID, but you are seeing those volumes just consistently outpacing those values. And it's really easy. I was amazed when I went onto the website to kind of like look into this more, whether you're going to the Hoyts or the events. This is not free promo, but, you know, if you're a moviegoer, like almost not every day, but there's so many discounted options, like whether it's Cheap Tuesdays or like movie of the week or that now Cheap Tuesdays is also a Cheap Sunday option. Like it's just really spreading, and I guess that's kind of the industry has had to adapt a bit, you know, coming out of COVID, and you know we all have our streaming services, so you have to do something, but it has shown that, you know, that discounting has had a material effect there.
Yeah, and demand. So maybe that's what we'll see more, you know, more general across retail goods and services in this upcoming you know, holiday trading period. And, you know, we do need to see. And also, interest rates are much lower today than they were this time last year going into this period. So there could be more money in people's back pockets to be spent on things other than food and rent and council bills, some more fun stuff.
Yeah. So you mentioned interest rates, and I think it's really important that we reiterate this and touch on it. Today's print, inflation rose to the top end of the RBNZ's target band, 3%. We already said we're not worried about it, but let's just clarify. This doesn't change anything for our interest rate outlook in terms of another cut coming in November, right?
Yeah, it doesn't. I don't think going to 3%, it's a frustration. It's not the number we want to see, but it shouldn't stand in the way of the Reserve Bank cutting again in November and delivering another 25 basis points. Because for them, they're looking at what's more important for them is the underlying inflation, what core inflation is doing. If you strip away the more volatile parts of CPI like food and like fuel and like these council rates and all the rest of it, it shows that those measures of inflation are very much either inside or heading towards the Reserve Bank's 1% to 3% target band. So they don't have to panic too much given that trend is very much subdued. It's a reflection of a weak economy. You know, those factors that have lifted inflation to 3% should prove temporary. Which is probably like a curse word after COVID saying temporary, but it does look like it'll be just a one-time blip higher. And we're approaching a quarter which is seasonally soft for prices anyway, so we could see that headline rate fall back below 3%.
So December being seasonally soft because of, I guess, that seasonality with food prices, like your fruit and veg.
Yeah, that and also the retail discounting that we talked about, and airfares, those kind of things are seasonally soft during the December quarter. So we could see that year-on-year print that's at 3% currently fall back, you know, below that 3%. But I guess so over the medium term, though, the risks we think are still tilted to the downside for inflation because of a host of reasons. What are we thinking in terms of the inflation outlook?
Yeah, I really like how we wrote it in our write-up today that we said, like, it's reached 3%, but it ends here because, you know, from here we do expect inflation to ease back towards that 2% midpoint by early next year. And then actually from there, the risk is that it undershoots that 2% sweet spot just because of all the spare capacity or just the weakness that's in the economy. And I think actually we've talked about it a couple times, but the fact that households are having to spend more on their essentials, it's acting like a bit of a tax on a household, on a consumer, which means, you know, that's actually kind of a bit of a demand shock in itself. So you might actually see even more discounting across these interest rate sensitive components. So there is a lot of downside pressure being exerted onto prices. So again, not something we're worried about. We see it coming back towards 2% and, you know, from there, risk of it falling further, especially with some of the global risks that are still going on. And then I guess for spending, like, the outlook is cautiously optimistic as well with this discounting that's coming about. I think you already mentioned it, but Black Friday, that's really going to be your kind of telltale sign. But it is just that household budgets are still under that pressure because, yes, they've had sort of interest rates come off, but now they're kind of battling with that rising essential items portion. But, you know, as interest rates do continue to move lower and, you know, households are rolling on to lower rates in the coming months, particularly in December, you know, just in time for Christmas, I think that will free up some of the disposable income and hopefully see spending kick a bit higher. And then on top of that, I'm going on to feel I've got passionate about this.
Yeah.
if we see these LVRs and just the housing market in general, picking up because of lower interest rates, then that wealth effect might, kick in and kick consumption a little bit higher too. So cautiously optimistic, if to round it all up.
I think cautiously optimistic is probably the perfect way to wrap it up. And that's for retail, that's for the outlook in terms of inflation, just being that 3% won't stick around, we don't think. We think it goes back to 2% and potentially below that. So I think that is a great way. I think that's a great point to wrap it up there. Right now, basically the message is don't panic that inflation is at 3%. There are factors underlying that should see it go back to the Reserve Bank's 2%. And we're still expecting a rate cut from the Reserve Bank in November, just with everything that's going on.
And that's all for this week. As always, be sure to like, subscribe, and follow us along. You've been tuned into This is Kiwi Economics, Markets, Mystics, and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.